We're now delighted to have at least one assassin of the business aviation industry speaking to us. Sean, if you'd like to come up. And also, we're now going to look at investing in business aviation. Ken gave us a fantastic introduction to this yesterday. We're delighted to have Sean Vick, AE Industrial Partners, needs no introduction, Neil Book from JSSI, and Nick Sandler from Stonebriar Commercial Finance. And to be fair, Nick does a bit more than just Stonebriar Commercial Finance, but he's very modest. And Neil's coming up. So Sean, let's start with you. How does it feel to be an assassin for the business aviation market?
Well, I've been called worse.
By people in this room.
Yeah. No, look, I get it. There's a lot of unknown aspects around private equity. It's not something that, our industry that we all grew up in had a lot of exposure in and around for, most of its history. But I would remind people, my first introduction to it was, in 1993 when, we went to Gulfstream at the invitation of Teddy Forsman, whom, had a big challenge on his hands at that point in time in order to get Gulfstream reoriented and get it back into the kind of condition it needed to be to thrive. And we were able to do that, and Teddy was very generous in, quite frankly, making sure those that were, significant contributors were going to participate ultimately in, the exit of that business. So it's been around quite some time, and if you think about it, most of the businesses that exist are, owner and founder or founder-owner oriented in a sense, right? They've used their own private equity in order to build those businesses.
Neil, you've taken private equity in the last few years, and you've used it to grow JSSI hugely and diversify. On the whole, are private equity guys bad guys? Apart from your investors, obviously.
I missed the question there, Al.
Are all private equity guys bad guys?
Are all private equity bad guys? I find if you deliver results, they're great guys. And so if you just focus on that, you're going to be okay. Let me also just quickly, while I have a second, this is really exciting for me. I started now in the industry almost 15 years ago. Sean has been so kind to me over the years. He's had success across so many different verticals in this space. So it's really fun and exciting to sit up here with him. And Nick and I share like an aviation father in Brian Moss. And so I feel like the two of us kind of grew up together in this space. And so it's a lot of fun to be here with him. I don't remember the last time I saw you. So thank you, Al, for bringing us all together.
It's great. Nick, you are very close to Ken. You've worked very closely. You're on the board of FlexJet. Ken is also very involved in Stonebriar. Do you see where he was coming from yesterday?
Yes.
Would you like to elaborate?
Look, I think we're living in an interesting time. I couldn't help when Sean said that he, in 1993, was invited to Gulfstream by Teddy Forsman. I was preparing for my bar mitzvah, but didn't have an appreciation for what went into all this. But I think that we're at an interesting inflection point in a lot of markets, and a good part of it's being driven by the growth of alternative asset managers. And what's important to those asset managers, I think, has changed over time. And no one who's allocating assets on behalf of a high net worth individual is ever going to get fired for investing in a KKR fund or an Apollo fund or a Blackstone fund, right? Mm-hmm. And if an investment they make goes poorly, they're still going to earn fees, and their stock price is still going to go up. And so I think it's a time where we all need to be paying a bit more attention to the motives of private equity. But I think on the whole, Ken made a comment where some institutionalization to the FBO businesses has been a good thing, right? And he's actually seen positive results and more consistency at locations with consolidation and the like. And so I think we hear about the bad situations more than we hear about the good, because that's the nature of media and how people want to talk and gossip. But in the end, we would be foolish to think that it hasn't, one, already very much made its way into this industry, and two, will continue to, as these firms raise billions and billions and billions of dollars to put to work.
And Neil, you have raised private equity, but
Yeah.
We've spoken before. You didn't go through a big process, did you?
I've never run a process, really by design. We're looking for very specific, we're looking for very specific partners, right? Partners who are going to be there, whether the business is up or down, and so we've always, worked hard to identify those partners who, will stand behind us, regardless of market conditions. And if the business performs, the multiples will be there.
Have you had as many calls? Private equity, business aviation was very hot as a sector. And the private equity guys picked up on the COVID bounce back faster than a lot of people. Are you getting as many people calling you saying we'd like to invest as you were 2 years ago?
Yeah, for sure. But again, I also think when you look at business aviation as a whole, it is still incredibly fragmented relative to other markets. And so I think the private equity market is looking at where can we do roll-ups, where is that arbitrage where you can, roll up several small companies and, have an arb on multiples. So I think there's still parts of this market that are relatively untouched.
Jordan, is business aviation as attractive now as it was 2 years ago?
Yeah, unquestionably. And I tend to look at it through the lens of, the industry maturation. If you think about the FBO vertical, right, in order for KKR and Blackstone to come in, right, they had to believe that they were investing in at-scale enterprises, right? They could deploy capital, right, through both acquisition and organic growth, and give them the returns that were required. So I think I don't know how the gentleman to my left feel, but I think it's proven out is a theory, and clearly they're enjoying success with those acquisitions. Now they are using infrastructure funds, okay, which very long duration, right, lower year over year return expectations than, let's say, a closed-end fund that's 8 to 10 to 12 years. But at that end of the spectrum, I think we've seen that maturation. We're also seeing the maturation in the MRO space. That's, I would say, about halfway through its journey. And the bifurcation between the OEMs, which, I think very wisely have invested in brick and mortar on a global basis because they see the long-term consistent earnings associated with a regulated service, right? You can't fly your airplane if it's not maintained, okay? So that investment, has been made in a very significant and appropriate way, which is levelized, their earnings profile. So that's good, which then requires that they don't have to be so dependent on the airframes in their up and down market. So we're not going to overbuild, hopefully. So now there's a relatively large, independent ecosystem out there that are getting larger and larger and more at scale. And you're seeing this bifurcation between, sort of the brand new airplane to about 8, 9, 10 years of age, and then the airplane from 8, 9, 10 years of age through the end of its life cycle. And I think that you're going to see private equity investment only increase in that MRO side. The charter and management side, again, highly fragmented. You've begun to see it. I had a ringside seat within the last couple of years. And I do see that, though, is so fragmented that it's going to be, I think that's going to follow the MRO vertical by some years before we see that further maturing.
You're being modest. You owned Solaris for 12 months. You're an expert on that market.
No comment.
Neil, you live and breathe the maintenance market. Do you agree with Sean?
Well, I think I think to Sean's point, we're starting to see, more and more entrants into that space and that bifurcation between independents and the OEM. And we thank God every day for that because, we live in a world of competitive tension. And the more players there are in the market, who wins? The consumer. You're going to get better pricing. You're going to get quicker turn times. And so we want to continue to see, independent shops enter the space.
Nick, you were nodding about MRA.
Yeah, no, I think, with respect to Sean's comments, I think that KKR and Blackstone have proven out an effective thesis on Atlantic and on Signature. However, they did it in a very different rate environment. And I think that the things that we're going to be facing going forward is how does the market ultimately adjust to higher for longer? M&A activities down, continuation vehicles are sort of the fad of the day, and this is where private equity firms raise third-party capital to effectively sell businesses they're either not ready to monetize fully to a third-party vehicle, roll their carry and their fees into that vehicle, and then provide liquidity to their legacy LPs. But, so you have rates, you have M&A environment, you have liquidity on one end of the equation. I think on the other end of the equation, something I've heard over the last few days is people, personnel, manpower. You can buy businesses, but if you don't have people to turn wrenches or to land airplanes, or even ground handling staff, all of these things are in short supply. And I think that's going to ultimately also drive a lot of decisions where consolidation can provide, for some people, job security by going to a larger organization, something of scale, and squeeze out some of the smaller players. And so whether that happens through organic M&A or through organic growth, right, is to be determined, because sure, we can go and gobble up a bunch of small businesses and integrate them, or you can build it yourself and kind of get to the same place and attract that talent.
I'm glad you brought up continuation funds. And Sean, do you think that, and you've also talked about infrastructure funds having a longer horizon, private equity companies do seem to be holding businesses for longer now, aren't they? Is that deliberate, or is that just exits are harder?
Well, it's both, right? It's both, because it depends upon the timing associated with, when it makes sense to exit. Do you have a ready, willing, and able group of prospective buyers that are willing to get into some competitive tension over the acquisition, right? That's the best outcome. But there's so much that, resides in the background in that marketplace that impacts appetite and timing. I mean, look, we're very likely going to end up going into, by most economists' viewpoints, some degree of a rate stabilization and increase if some of the policies that are being discussed go into place. They are inflationary. If you do that and the banks, hold or increase rates, right, that impacts the debt component that any private equity firm needs to have access to in order to manage an acquisition, right? Same things for their onward sale. If the marketplace is such that, loan to values on the asset go from, if it's a $100 million deal, you used to have to put 25 million in to borrow 75. If you've got an output 45 in to borrow the balance, your equation on the return on equity is different, right? So there's no simple answer. It's always up to market timing, and it's always up to the counterparty and whether or not this is a strategic acquisition, right? If this is something that is highly complementary, highly accretive, and really is necessary for them to grow, right, their platform business, then it's, the outcomes differ.
Yeah, I think look, you have competing forces, right? You have rates, costs of financing, return on equity. But if you look at the stock prices of KKR, Blackstone, Apollo over the last 15 months, they've effectively tripled or more. And they're not tripling because of great investment performance. They're tripling because of fee-related revenue and fee-related earnings are up. And so I think that probably bodes well for sellers of businesses that are there for institutional capital to want to draw fees from their LPs and earn fees to raise their own stock prices, and it's probably becoming less about creating alpha in the market and more about creating beta, because at some point you're just so big that you're just trying to, beat the index. You're not looking to create outsized returns.
And you've got this massive pressure to deploy capital, right? So the quality businesses are always going to do great because there's always a home for fresh capital. But you're starting to see a lot of sort of mid-tier and fledgling businesses get a massive amount of private equity just because of the overall demand for these large funds now to deploy capital quickly.
And how far down in scale do you think the buyers are going to go? Because, once upon a time, players like we're talking about, if it wasn't a $2 billion deal, $3 billion deal, they didn't give it a second look. Do you think that's going to be the same, or do you think they're going to come down market and look at subscale businesses from that?
Yeah, I don't think it's going to be massively trickle down. I do think in a nuanced industry like this one, you have no choice, right? But there's only so much size and scale. But that was my comment earlier about, do you pay, do you try to pay 12 times for something, or do you create it on your own? And I think they're gonna grow one way or the other, and I think it's gonna become circumstantial. But I don't, on a macro level, I'd say that, do I see people dipping down in kind of the upper middle market, so the $50 to $75 million EBITDA businesses? Yes. Do I see it kind of going down to the lower, which is kind of your $15 to $25 million EBITDA business? If I'm Apollo and I have to deploy $250 billion of capital in 2025, I don't know if I'm going to spend a lot of time on that $15 to $25 million business versus I might say, okay, that 50 to 75 is probably the juice could be worth the squeeze.
Sean, where are you seeing opportunities? AE Industrial Partners has been, you've invested quite heavily in supply chain companies. You've had some success selling them to strategic investors, and where are you looking at opportunities now?
Well, the firm, has a much broader perspective, outside of, just all matters aviation as well. A lot of defense, a lot of opportunities in space systems, a lot of opportunities in government services. We've recently invested heavily in an office in Washington, D.C. to look over, the efforts and the investments that we've made in those markets, which I think is a very wise application of talent, for the firm. Generally speaking, it's a firm that has a requirement in its acquisition strategy for businesses with, what we call critical toll booth technologies or products or services, right, that are required in that specific ecosystem or that vertical, so that you've got solid long-term earnings potential. And then you think about what you might do organically to grow that, or what you might do through M&A to grow those businesses. Look, there's never going to be any shortage of opportunity, and even in this environment where a lot of our industry is subscale, but it's got focus and interest from, some of the largest PE players out there, that's an opportunity for the middle market players to help consolidate, high quality businesses into larger businesses that might start out at, 15 million of EBITDA and get them to 50 million of EBITDA, $75 million of EBITDA, and then you will get a look from those larger, at-scale PE firms. And one last comment back to the, the question around the quality of the PE firms. Look, every firm is different, okay? Each firm's culture is different. I will tell you that I've known for a long time from mentors and coaches I've had that culture trumps strategy every single time. So if you're going to do business with another firm or somebody who's looking at acquiring your business, make sure you're, grounded on common values and what win looks like, especially if you're going to roll, okay, and stay in there. I really appreciate the comment made. Everybody hears about the bad, events that happen. There's probably 3 to 4 times as many good outcomes and great stories. But they're just not interesting to talk about for most people.
No, let's not bother with those. Let's
And I agree with you, Sean, and I do think, operators have an obligation to their employees to know who they're bringing into their boardroom. And so, to your point, while there's so many processes today, there's a lot of value in, striking a fair price, avoiding a process, and partnering with, setting up long-term relationships.
That's why Neil's never let me into his boardroom. So.
That's right.
Yeah, and look, just one sort of, shameless plug for, my favorite firm, AE. Look, we have a group of people who are industry operators, dozens and dozens of years of experience that have had to face the trials and tribulations of running a P&L, right, as a chief financial officer, as a chief executive officer, as a chief risk officer in these businesses. And so, when we approach it from the perspective of, is this a business that has a potential to grow? Is it in a vertical that we like? Is this management team on the same page that we are? And are we on the same page that they are? Okay, and let's get together and go do something jointly beneficial. And what we don't worry about is there's no conversations about, hey, we've been in this for 5 years, it's time. It never happens. It's not helpful, it's not constructive, and I think it's part of why you see some longer holding times, because everybody realizes this is a cyclical marketplace, and trying to force something to happen in a time that isn't constructive serves no one's interests.
Neil, do you feel pressure?
No, I never feel, pressure I never feel pressure to transact. I think our responsibility is to perform, right? And if you focus on executing, I've found everything else, falls into place and works out. The pressure comes on, performance and execution on performance, not to transact. That's the fun part.
Okay, nice audience question. How would you describe current investor confidence in business aviation in one word?
That's not what the question says, though.
Sorry?
Yeah.
Give me 1 second, Nick. How would you describe current investor confidence in business aviation in one word?
Great.
Yeah, great.
Great.
Nick,
having
how would
this-
you describe it in more than one word?
Look, I was just thinking about it, right? I mean, if you look at the landscape of institutional capital that's come into deals, I think by and large they've mostly been successful. Neil has been successful both on the debt and equity side. Sean's been very successful on multiple platforms. We've had a lot of success, be it FlexJet, Simcom. Just on the core financing business, KKR and Blackstone have success. I mean, look, KKR had tremendous success with JetEdge, right? So I think when you've looked at the institutional capital coming in, I think there are far more good stories than bad. I think the deals that maybe haven't worked out as well could be operator to operator, but again, time can heal those wounds, right? When you've top ticked a market or looked at an interesting environment. And again, those still happen in a relatively low rate environment, and so that can forgive a lot of sins and work themselves out. But I think by and large, this is a space where investors have not been burned yet, and so I think the key is to continue that.
Okay. Business aviation feels like an inherently fragmented industry, and so many parts are already a duopoly. Is there really room for more consolidation?
There is. It is a highly fragmented marketplace. There's. I guess we would describe within the FBO, space that there's a duopoly, right, between Atlantic and Signature and their respective owners. But listen to what Ben has just said. They're deploying capital, and they're building more than they're buying, as well are several others. Brian Kirchdoffer, Clay Lacy, he's been doing the same thing. So, look, I think that it is highly fragmented. Even in the MRO businesses, it had tended to be regional in its distribution by default, okay, not necessarily by design. In the MRO space, in the charter and management space. I mean, look, once upon a time, if you were, I remember we were trying to analyze when we were putting together Landmark Aviation, where to go buy, the next series of FBOs, of which while we were there, we acquired some 30 FBOs, okay, ended up putting together 60. This was the predecessor to Signature. And it was interesting because at the end of every analysis, it turned out to just simply be every NFL city. So it's like, how about we stop paying all these advisors to tell us where to go? Okay, just go look at every NFL city. Well, guess what you had there? Okay, you had 1 or 2 FBOs, okay, maybe 3. You had 4 or 5 charter and management operators, okay, and you had 3 or 4 mom and pop shops to turn wrenches on airplanes, okay? Well, guess what? That's the very definition of a highly fragmented marketplace. It really, really hasn't changed a lot since then, other than at the FPO end, and it's beginning to change on the charter and management and on the MRO side, okay? So I think there's a long runway to go in terms of consolidation in this fragmented market.
The other strategy I notice is some FBO chains just seem to pick nice places. They do the Caribbean, they do, that's the other strategy, isn't it? You do NFL teams or you do places you'd like to visit.
That's because people that own airplanes like to go there.
I'd just like to add to Sean's comments. I certainly think there's a lot of room for consolidation, right? We're in the parts business, okay? And I think last year we bought parts from 47 different companies, okay? You would not believe how many small mom and pop shops are out there. I mean, there's just remarkable amount of variety all over the world. So I think that's a market that there's a real opportunity for some roll-up activity. We're also in the maintenance tracking software space. We've been able to acquire 2 companies in that space, but earlier this year, there's another player that entered the market who's having a lot of success and doing a great job. And so, I think if you look around, there's certainly pockets where there's a lot of fragmentation and opportunity for consolidation.
Hard to add to those 2 comments, but I think we all agree there's more to come.
Okay. How do you benchmark the valuation of an FBO versus an MRO?
Someone wants us to do their credit work for them.
I think someone wants to know how much their business is worth.
Yeah, look, the MRO, I think, probably commands a higher multiple than the FBO. FBOs have been bought in infrastructure funds for a reason. It's a long-term asset. MRO, I think, is more specialized, more in demand. I think that obviously right now, the biggest barrier, right, to more activity outside of kind of rates is just going to be valuations. And, I think a lot of people are still hung up on what businesses were worth in 21 and 22 and not sure that those multiples are relevant today. But I think at the end of the day, you're going to see higher multiple for a, well-established MRO business that can, integrate and plug into a better infrastructure and synergize than I think you are at this point on the FBO side, just because there's been so much activity in that space.
I mean, last I checked, Standard Arrow, I think, is trading at a 20 multiple. Incredible.
What they said.
I'm beginning to think Sean might be working on a FBO or an MRO deal and not wanting to give away too much.
Let me know if you need financing.
How would you value an aircraft leasing business? Nick, do you know anything about
Very high.
that? Sean, same.
Look, I think, I think, well, let's call it what it really, it's an aircraft leasing and finance business, right? I'd say that, at least for us, right, it has not been a particularly busy 23 and 24 from an origination standpoint, which is rational when you think about living in a SOFR above 5% for most of that period of time, and then tacking on the spread and tacking on the amortization, the cost of capital becomes alarmingly high relative to some of the more traditional bank options that, have more, structure around them and covenants and guarantees and the like. But I think that, we've had to ask ourselves when we're doing a high net worth deal in the last couple of years, like, does it really make sense for someone to pay an 11% rate and 10% year amortization, right? It's just, it's been tricky. However, I think that in the era of asset-based finance becoming more and more interesting and attractive, we're seeing stronger valuations. It's always should be off a multiple of book. If you did it off of EBITDA, if you can find someone to value off of EBITDA, please call me. I'd like to meet them. But these are book value businesses in the end, and I think that public multiples are, I think still not completely clear relative to, say, what I think Stonebrier's are worth or what Sean thinks Global Jet Capital is worth, because we probably haven't seen the true comparable asset. But I think at the end of the day, it's still a multiple of book trade. And then, but that then leads you to ask yourself kind of where we began the conversation around the alternative asset managers, which is, how do you turn these more into fee-related revenue businesses? Because fee-related revenue and fee-related earning businesses can get 12 to 20 times multiples depending on the stickiness of the assets, where as a leasing business, all the public ones are trading below 1 times book, and private deals have probably transacted really on the high end at 1.5 to 2 times book. And so you sort of see if you can recharacterize your income in a way where you can get a higher multiple. And the way you do that is proving to the market that your assets and those revenue streams are sticky.
Yeah, the other observation I would make is far too many folks come into this conversation around the valuation, if they're talking specifically about business aviation, aircraft, financing and leasing. Their proxy is commercial aviation. And I learned a phrase from the 10 years I spent at British Aerospace early in my career. They're as different as chalk and cheese, okay? And the business aviation leasing ecosystem is really an equipment leasing ecosystem. All of its characteristics, all of its underlying strengths, are akin to equipment leasing. And commercial aircraft leasing, as we all know, has got a monolithic, orientation towards one industry, which is commercial airlines. All of their eggs are in one basket. So for those involved in business aircraft leasing, the diversification across, 30, 40, 50, 60 industries, right? With counterparties who are ultra high net worth, owners of very successful businesses or, investment grade, corporate obligors. So when we think about it, yes, it's going to be a function of a multiple of book, but it's a different animal altogether than commercial aircraft lessors. And I think valuations associated with that is an operating platform, its counterparty risk, have to demand a premium above of that other proxy, certainly more aligned with very successfully well-run equipment leasing businesses.
You're selling your book very well there.
Speaking the truth, brother.
Are there good BizAv investment opportunities outside the US?
Look, I think the challenge has always, at least as long as I've been in the industry, is the demand, right, for the product outside the U.S. is robust, but the infrastructure and therefore the ability to create the supply has always been the challenge, right? If you grow up in the United States, you lose perspective on just how great this infrastructure is. Airports everywhere, ease of following flight plans. You want to go from LA to Vegas, the probability of you sourcing an airplane in a few hours and getting that trip done is pretty high. But if you're in Singapore and you want to go to Macau, you need like 3 days notice for overflight and different, landing slots and everything else that comes with it. And so, yes, I think there are opportunities outside. I think it requires patience, and it also, I think it requires patience because it's not a problem you can throw money at. necessarily. And Ken alluded it a little bit yesterday of sort of how FlexJet's looking at international and has had tremendous success in Europe, where customers are actually airlining over and then using FlexJet within Europe. And it's become a real necessity for the business, but to now figure out how to monetize some of those planes when a European customer is going to the Gulf region and someone wants to come back. And, we are going to get there on it, but it doesn't happen overnight because, again, you have to have, 6 or 7 dialogues in a region, where in the U.S. you're having one. So it takes time.
Neil, your globe.
Yeah, look, I think there's, good investment opportunities here and abroad, and there's shitty opportunities here and abroad. You have to really be disciplined, and, we find that, roughly, right, 65% of the world's business jets are based here in the United States. Here's where you're going to find the majority of businesses and opportunities. But to Nick's point, if you're thoughtful and you're disciplined, there's opportunities everywhere.
Sean, how do you decide whether an organization's culture is a good fit?
It's a really good question. And it always starts at the senior leadership level, okay? And it's a function of, for instance, if you're looking at an MRO business, right, that's family owned, and you want to understand, how that business has been built and what type of culture has been creative, and this is somewhat simplistic, but, it works. Try to understand what their safety culture is, right? First and foremost, because no business operates without people, right? And if you're hurting people reliably over time, okay, you're probably not running a very good business, okay? So you have to listen to the details of how people speak about what matters to them beyond just the P&L, okay? And how much the employee group is engaged with and how much they participate in helping to shape the future of that business. If you've got one person sitting in the corner of the room, right, who, possesses all knowledge, right, and owns right, I would urge you to walk away quickly, okay? But if you've got people who are collaborative, who understand that they don't own right, that they don't have all the answers, that they need help, okay? But their fundamental values about how they're going to treat one another, right, and be expansive in ensuring that people are able to participate in the success of the enterprise, then you've got a great foundation to start from.
Okay, here's a nice one for you guys as operators rather than just investors. What's the best way to acquire new clients?
I mean, I view my job above all else as just an originator of assets, right? People ask me, what do I do? That's what I do. We're all Willy Loman with bigger balance sheets. I think it's a deep commitment and a tenacity to that endeavor. And I think that as you gain more experience, you allocate your time better. So 15, 20 years ago, I didn't spend my time very well, right? As the years go on, you kind of learn where to focus and you learn, what's going to matter and you figure out what you're fighting for. But that's not something that you can sort of just say, okay, do these 3 things and go. It's something that's learned over years and years, and it's failing, and it's failing far more than you're succeeding, and it's learning from those failures is what kind of drives you to the right spot. I think it's a Vince Lombardi quote, which is, if you strive for perfection, you get excellence. And I think that's, those are words we use a lot in the organization, and we also use another phrase, which is don't let perfection be the enemy of good.
For me, it's never take a client for granted. We find ourselves, JSSI is always in a position where we're typically the underdog on a deal, right? We're either competing with the manufacturer on the program side, on the software side, we're competing with CAMP, and so we feel like we have to be perfect. You know, it's not just price, it's really communicating the value and, you know, working to deliver a great product and a great service to each and every customer and treating each and every customer like they're the only customer in the world. And so if you do that repeatedly, you'll find that's where we've found success.
Proactively define what you want for a reputation. Okay? Reputation. Reputation equals brand. Then be authentic about assessing, do you live into that reputation, right? If you don't, figure it out, live into it, and then go to that market, exercise everything you do around making sure that is a reputation that you leave on the field every day. And the clients will come to you.
Brilliant. Thank you very much, everyone. Thank you.
Thank you.
Thanks, Al.